Right now, Plug Power, trading under the ticker symbol PLU, is experiencing a significant intraday downturn, with the stock priced at $3.77, a sharp decline of 8.6% in today's trading session. This volatility is precisely what draws so many traders to this name, yet what most are missing is the seismic shift happening just beneath the surface. Today, the company announced a monumental leadership transition. Long-term CEO Andy Marsh is set to become executive chair of the board, passing the CEO baton to José Luis Crespo, the current chief revenue officer. The market's knee-jerk reaction is clearly negative, interpreting this as instability. But this is a profound misreading of the situation. This isn't a sudden departure, it's a strategic succession planned for March 2026, designed to pivot from visionary growth to disciplined, profitable execution. Crespo's background is in sales, revenue, and customer success, the very areas Plug Power must conquer to silence the critics. The market sees a shakeup. The reality is a calculated move to fortify the company for its next and most critical chapter. The prevailing expectation for Plug Power, often amplified by chatter on platforms from the Robinhood app to sophisticated forums used by those with interactive brokers accounts, is that it's a high-risk, high-reward bet on the future of the hydrogen economy. It's seen as a company perpetually on the verge of a breakthrough, fueled by government subsidies and grand promises, but consistently undermined by staggering cash burn and a lack of profitability. This narrative paints a picture of a speculative instrument, not a foundational industrial company. The reality, however, is far more nuanced and complex. While the cash burn is an undeniable and critical risk, the market consistently underestimates the tangible, infrastructural moat Plug Power is building. This isn't just about fuel cells anymore. It's an end-to-end ecosystem encompassing green hydrogen production, liquefaction, storage, and logistics. This vertical integration is a Herculean task that explains the immense capital expenditure, but it's also a strategy that, if successful, could lock in customers and create a significant competitive advantage that pure-play component manufacturers cannot match. The expectation is a story of hope. The reality is a story of grueling, expensive, but potentially dominant industrial construction. This tension is visible in the stock's recent violent swings. Today's drop comes after a period of incredible strength. Over the past month, the stock nearly tripled, driven by a confluence of factors that many retail investors, perhaps doing some self-investing for the first time, might have missed. There's a growing sentiment that the insatiable energy demands of artificial intelligence data centers cannot be met by the grid alone, forcing a look at alternative, constant power sources like hydrogen fuel cells. Furthermore, a renewed optimism around nuclear power, particularly small modular reactors, is seen as a long-term catalyst for producing cost-effective green hydrogen. This narrative helped fuel a massive short squeeze, with short interest recently hovering above 30% of the float. When a stock with that level of negative sentiment gets a gust of positive news, the subsequent rally can be explosive as shorts are forced to buy back shares to cover their positions. The trading volume has been staggering, frequently exceeding 400 million shares, dwarfing its average volume of around 138 million. This isn't just a gradual re-rating, it's a battlefield between deeply entrenched bulls and bears, a dynamic that guarantees continued volatility. The institutional landscape reflects this conflict. While some major funds like Norges Bank and Heights Capital Management have drastically cut or eliminated their positions, others like Vanguard and Geode Capital have been modestly increasing their stakes. This divergence among the so-called smart money shows a deep-seated disagreement about the company's future, a far cry from the monolithic buy or sell narrative one might find on social media. At its core, Plug Power is a pioneer in the development of hydrogen fuel cell systems, specifically those based on proton exchange membrane (PEM) technology. Founded in 1997, the company has positioned itself as a comprehensive solutions provider for the burgeoning green hydrogen economy. Its business model is multifaceted, generating revenue from the sale of fuel cell systems that replace traditional batteries in material handling vehicles like forklifts in warehouses for major clients such as Amazon and Walmart, stationary power applications, and on-road electric vehicles. Beyond the hardware, a significant and growing part of their strategy involves building out the entire hydrogen infrastructure. This includes producing green hydrogen through their own electrolyzer plants, developing cryogenic storage and transportation solutions, and building fueling stations. This ecosystem approach aims to create a closed-loop solution for customers, making the adoption of hydrogen simpler and more reliable. This vertical integration is their biggest gamble. It requires immense capital, as evidenced by their balance sheet, but it's also their primary differentiator. Past financial reports have been a source of significant concern for investors who use services ranging from Fidelity Wealth Management to SoFi Invest. The company has a long history of negative earnings and significant cash outflows. The most recent Q3 earnings report showed a 12.6% year-over-year revenue drop, missing analyst estimates. Gross margins have been deeply negative, a major red flag for any manufacturing company. However, the company has also shown progress in reducing its cash burn, with operating cash flow burn improving by 34% year-over-year in 2024, demonstrating a clear focus on financial discipline. Looking ahead, the future of Plug Power hinges on three critical factors: the cost of hydrogen, the pace of market adoption, and the company's own ability to execute its ambitious plans. The biggest catalyst on the horizon is the continued global push for decarbonization, supported by government incentives. Projects like the delivery of a 100-megawatt electrolyzer system to Galp's refinery in Portugal are tangible proof of this momentum. Scaling these deployments is the key to achieving profitability. The expansion into new markets, such as providing backup power for AI data centers or developing solutions for aviation, represents significant upside potential. But the risks are equally substantial. The primary challenge is achieving cost competitiveness with existing energy sources. Green hydrogen is still expensive to produce, and without subsidies, adoption will be slow. Secondly, there is immense execution risk. Building a nationwide or global hydrogen highway is a monumental logistical and financial challenge. Any delays or cost overruns could further strain the company's finances, a concern for anyone managing their own individual brokerage account. Finally, the company faces competition not only from other hydrogen players, but also from advancements in battery technology, which could erode some of its target markets. Comment below on whether you believe government subsidies are essential for Plug Power's success over the next 5 years. In summary, the story of Plug Power stock is the ultimate embodiment of the tension between a bold, world-changing expectation and a harsh, capital-intensive reality. The market's initial reaction to the CEO transition focuses on the perceived instability, ignoring the strategic pivot towards execution and profitability that this move represents. The common belief is that of a speculative, cash-burning venture, yet the reality is the painstaking construction of a vertically integrated industrial ecosystem that could dominate a future energy landscape. The daily price action is a chaotic reflection of this conflict, with AI narratives and short squeezes clashing with concerns over financial viability. For investors considering anything from Apple stock to Nvidia stock, or utilizing sophisticated tools like Schwab Intelligent Portfolios or Fidelity ETFs, the lesson from Plug Power is clear. The most compelling opportunities and the greatest risks often lie in the vast gap between the story the market tells itself and the complex reality unfolding on the ground. The path forward will be anything but smooth, but for those who understand the true scale of Plug's industrial ambition, the long-term picture is far more intricate and potentially rewarding than today's dramatic price drop would suggest.